Japan has one of the largest pools of household savings in the world, over 1,190 trillion yen, earning almost nothing. That is a structural problem that has defined Japanese capital markets for over 30 years. In this presentation, I want to explore a new financial instrument that could change that story, the BitBond. A BitBond is a Bitcoin-backed bond, and it could be one of the most significant fixed income innovations to come out of Japan in a generation. Let's dive in. Before we begin, I would appreciate it if you could hit the like and subscribe button as it helps this channel. This video does not constitute financial advice. Please do your own research. So, what exactly is a BitBond? At its simplest, a BitBond is a bond, a debt instrument where the issuer's collateral is Bitcoin held on their balance sheet. Think of it like a covered bond in traditional finance. When a bank issues a covered bond, investors are protected by a pool of mortgages on the bank's books. If the bank defaults, bondholders have a claim on those assets. A bit bond works exactly the same way, except the underlying collateral is Bitcoin, not mortgages or real estate. The investor receives a regular coupon payment in Japanese yen. The issuer uses the capital raised to acquire more Bitcoin, and the existing Bitcoin treasury serves as the security backing the bond. The central question I always ask when I analyze a new instrument from a Bitcoin treasury company is this: does this increase BTC per share? With a well structured BitBond, the answer is yes, because capital is raised at a fixed borrowing cost, deployed into Bitcoin, and the shareholder base is not diluted. To understand why BitBonds matter in Japan specifically, we need a short history lesson. In the 1990s and 2000s, Japan gave birth to a remarkable instrument called the Uridashi bond. These were bonds issued by foreign governments and corporations, but sold directly to Japanese retail investors through domestic brokerages. Why? Because Japanese savers were earning almost zero at home, while New Zealand, Australia, and South Africa were paying 6 or 7% annually. At its peak, the Uridashi market channeled tens of billions of dollars annually from Japanese households into foreign currency bonds. But that era faded. Global interest rates converged after 2008. Currency losses hurt retail investors. The products became harder to sell. The problem, however, never went away. Japan's household savings pool has only grown, now exceeding 2,000 trillion yen, while real returns remain near zero or negative in inflation adjusted terms. The table on screen shows the structural parallel. Same problem, same mechanism, new asset. In the Uridashi era, Japanese savers reach for foreign currency yield. With BitBonds, they would reach for Bitcoin-backed yield in yen through a regulated domestic platform. And critically, Bitcoin cannot be printed. Before we look at specific BitBond structures, it's worth pausing on why Bitcoin makes such compelling collateral. First, global liquidity. Bitcoin trades 24 hours a day, 7 days a week, across hundreds of exchanges worldwide. Unlike real estate or private equity, it can be liquidated rapidly when needed. Second, transparency. Anyone in the world can verify exactly how much Bitcoin a company holds in real time on the blockchain. No hidden liabilities, no off balance sheet surprises. Third, scarcity. Bitcoin supply is fixed at 21 million coins. It cannot be debased by a central bank. That is a property no government bond can claim. Fourth, an existing institutional collateral market. This is not theoretical. Metaplanet has already drawn down 355 million US dollars against its Bitcoin holdings through a BTC collateralized credit facility. Major institutional lenders already accept Bitcoin as first class collateral. The market for this exists. The question is, who builds the products on top of it? The primary risk, which I'll address later, is Bitcoin's price volatility, but that is manageable through conservative loan to value ratios. Let's look at the first BitBond structure and the most straightforward, the fixed rate BTC collateralized corporate bond. Here's how it works. Metaplanet issues a corporate bond with a fixed yen coupon, say 3 to 5% annually, for a term of 2 to 5 years. The bond is secured by a specific allocation of Bitcoin on Metaplanet's balance sheet, ring-fenced as collateral. A loan-to-value ratio is maintained, for example, 50%, meaning the Bitcoin backing the bond is worth at least double the bond's face value at all times. The coupon payments are funded from Metaplanet's operating cash flows. Principally, its Bitcoin income generation business, which generated 8.58 billion yen in revenue in FY 2025. This is the closest equivalent to a traditional secured corporate bond. It is the easiest for institutional investors to underwrite using existing frameworks, and it requires the least investor education. Importantly, Metaplanet has already been on the borrowing side of this exact type of transaction. This structure simply flips it. Metaplanet becomes the issuer, offering yield to the market. The second structure is more sophisticated and one of the most interesting products in the BitBond toolkit. I call it the dual structure BitBond. The base coupon is a low fixed yen rate, say 1 to 2% annually. That is the guaranteed floor for the investor. But on top of that, there is a variable component linked to Bitcoin's performance over the bond's term. If Bitcoin appreciates above a preset strike price by maturity, the investor participates in a portion of that upside. If Bitcoin ends below the strike price, the investor simply receives their base coupon and principal back. The downside is kicked. Think of it like an equity linked note, familiar to many fixed income investors, but with Bitcoin as the reference asset instead of a stock index. This structure is designed to attract investors willing to accept a lower guaranteed yield in exchange for Bitcoin upside without taking direct spot Bitcoin exposure. It converts Bitcoin's asymmetric return profile into a structured product that fixed income mandates can actually hold. The third structure is perhaps the most strategically important for Metaplanet's specific position in Japan. I call it the Uridashi-Style Retail Bond because it is modeled directly on the original Uridashi bond format, but with Bitcoin backing instead of foreign currency exposure. Here's the proposition. A yen-denominated bond paying 2 to 4% annually, structured specifically for Japanese retail investors and distributed through Metaplanet Securities. To put that yield in context, the 10-year Japanese government bond has spent years paying below 1%. A 2 to 4% yen yield, backed by 40,000 Bitcoin, is a genuinely compelling proposition. The minimum investment would be kept low, perhaps 100,000 to 500,000 yen, making it accessible to the approximately 250,000 retail shareholders who already hold Metaplanet stock. But here is the structural advantage that the original Uridashi era never had. In the Uridashi era, the issuer and the distributor were completely separate entities. The New Zealand government issued the bond. A Japanese brokerage distributed it. Both took their cut. Metaplanet controls both sides. It is simultaneously the issuer through its Bitcoin Treasury and the distributor through Metaplanet securities. Those economics collapse into a single entity. That is a fundamentally more powerful business model than anything the Uridashi era produced. The fourth structure is the shortest in duration, BTC-backed short-term notes. These are rolling instruments with terms of 3 to 12 months, paying a floating yen rate, pegged to the Tokyo overnight average rate plus a spread. For investors who cannot commit capital for 2 to 5 years, short-term BTC-backed notes offer a more conservative entry point into Bitcoin-backed yield. And from a risk perspective, shorter duration actually means less exposure to Bitcoin price movements over the life of the instrument. For Metaplanet, short-term notes provide a flexible, rolling funding mechanism that can be repriced regularly with market conditions, without requiring a full bond issuance process each time. The target here is institutional, corporate treasuries sitting on idle yen cash, insurance companies with short duration mandates, and liquidity focused investors who want yield but need capital flexibility. Taken together, these four structures cover the full spectrum of the fixed income investor universe, from 2-year retail bonds to 5-year institutional instruments to rolling 3-month commercial paper. Now, let's talk about the revenue opportunity. First, some context. Metaplanet already has an operating revenue engine, its Bitcoin income generation business. This generated 1 billion yen in FY 2024, 8.9 billion yen in FY 2025, and 3 billion yen in just the first quarter of FY 2026. The trailing 12-month revenue pace is approaching 11 billion yen. BitBonds would be a structurally separate, additive revenue stream on top of this base. Metaplanet's revenue from BitBonds would flow through 3 layers. Layer 1, origination and structuring fees earned at issuance, typically 0.5 to 2% of the bond's face value. Layer 2, distribution fees through Metaplanet securities when placing bonds with investors, historically 1 to 3% in Japanese retail bond markets. Layer 3, ongoing management and administration fees of around 0.3% annually on outstanding bond volume. Now, the illustrative scenarios. At 50 billion yen in BitBond issuance, we're looking at approximately 650 million yen in year 1 revenue. At 150 billion yen, approximately 2 billion yen. At 500 billion yen, still less than 0.05% of Japan's addressable savings market. The number approaches 6.5 billion yen annually. At the larger scenario, BitBonds would approach the scale of Metaplanet's entire existing revenue base. These are illustrative, but the order of magnitude matters. So, does all of this actually increase Bitcoin per share? Let's answer that directly. Yes, through 2 distinct mechanisms. First, the proceeds from BitBond issuance give Metaplanet non-dilutive capital to acquire additional Bitcoin. Capital raised at a fixed borrowing cost, deployed into Bitcoin, increases BTC on the balance sheet without issuing a single new share. Second, the operating fee revenue generated by Metaplanet securities from structuring and distributing BitBonds is cash flow that can be directly reinvested into Bitcoin purchases. Every yen of operating profit converted into Bitcoin on the open market raises BTC per share with zero dilution. This is the compounding loop at the heart of Project Nova: stack, flow, reinvest, grow. BitBonds are the flow mechanism at its most powerful. Now, the risks. I want to be direct here. Bitcoin price dependency. The entire collateral base of every BitBond structure is Bitcoin. A sharp price decline compresses collateral coverage and reduces issuance capacity. This is manageable through conservative loan-to-value ratios, but investors must understand it clearly. Competition from incumbents, SBI Securities, Nomura, and Daiwa are watching. If Bitcoin-backed yield products prove commercially attractive, larger institutions may enter the space. First mover advantage is valuable, but it is not permanent. Execution risk. Metaplanet is simultaneously integrating a licensed securities firm, building an asset management arm in the US, running an active Bitcoin options program, and managing 40,000 Bitcoin. That is genuinely complex. And finally, investor education, explaining Bitcoin collateral and loan to value mechanics to Japan's retail investor base requires building financial literacy that does not yet exist at scale. That takes time and sustained effort. Let me close with three thoughts. First, the opportunity. Japan has 30 years of pent-up demand for yield. The Uridashi bond era was the last great answer to that problem. BitBonds offer something structurally superior: yen-denominated income backed by Bitcoin, the one asset that cannot be printed, distributed through a vertically integrated regulated platform. Second, the question. The central question I keep returning to is not whether the demand exists. I believe it clearly does. The question is whether Metaplanet can execute across product structuring, regulatory approval, and retail distribution before a larger incumbent with more resources replicates the model. Third, the signal to watch. For investors thinking in Bitcoin per share terms, watch two things: the pace of BitBond issuance volume and the operating fee revenue line at Metaplanet Securities. When those numbers start appearing in quarterly results, the compounding loop will have begun in earnest. Thank you for watching. For the full written analysis, you can find the article at Metaplanet Dojo. The link is on screen. I'm Uncle Dividends, and I'll see you in the next one. Disclaimer: this presentation reflects my personal research and opinions. It is for informational purposes only and is not financial advice. Always do your own due diligence and consult a licensed financial advisor before making any investment decisions.